58%, 116%. Two returns on the same apartment for the same 3 years with the same profit in dirhams in the same city. And yet, one buyer nearly doubled the return his money on what they actually put in. So it wasn't the view, the deal, or the timing. It was one decision, and that decision has a name: leverage. I'm Iram Parker, Director of Private Wealth at Xperience Realty Dubai, and over the next few minutes, I'm going to deep dive into 6 things. 1. What leverage actually is and why the rich borrow when they could pay cash. 2. The move almost nobody explains, which is financing at handover. 3. The real math of cash against leverage on the same flat. 4. What this exact strategy costs you everywhere else in the world. 5. What actually decides your terms here. And 6. The honest part, the day leverage turns dangerous. So stay for that one, because no agent will put this in a reel. I grew up in Mumbai, so I know exactly what expensive, heavily taxed, low-yielding property feels like. I live in Dubai now. I invest here. I have real skin in the game. So I'm not here to sell you a building or a bank. I'm here to show you how money actually moves. But before the numbers, let me define the word, because everyone uses it and almost nobody explains it. So leverage is borrowed money, usually the banks, to control an asset far bigger than your own cash could buy. So you put in a little, the bank puts in the rest, and your return is measured against the little you actually put in and not the full price of the property. So hold that thought, it is the entire video. So let's start with the spread. Why the rich borrow? The UAE Central Bank base rate is 3.65%, and fixed mortgages in 2026 sit roughly between 3.99 and 4.5% for the initial period. Now look at what a well-chosen asset in the communities I actually work in is doing. 11 to 12% annual capital appreciation with a rental yield of 6 to 9% on the top. So you're borrowing at 4 and putting it to work at 17 or more. This gap is not a trick. It is the entire reason institutions use debt. Cash does the opposite. It takes your most flexible asset, which is your liquidity, and freezes it inside a set of walls. A client of mine, the APAC head of a major energy company, called me from Singapore and put this perfectly. He didn't ask which apartment was the nicest. He asked how to make $1.5 million behave like 4. This is the difference between a buyer and an investor. And here is the part most people miss. Those central bank loan caps everybody complains about, they're not there to limit you. They are there to protect you from yourself. And they are exactly why this market did not detonate the way Dubai did in 2009. So rich does not mean paying for everything. Rich means knowing whose money to use. The people who pay for a single unit in cash are rarely the ones building portfolios. They are the ones who actually call me 3 years later asking why their money has been asleep. And honestly, their money is not nervous about the interest rates, but it's not doing anything interesting enough to be nervous about. Now, let's move on to the part nobody explains, which is financing at handover. So while a project is under construction, the central bank caps any mortgage at 50% of value. And most banks will not finance off-plan for a non-resident at all. So during the build, you are on the developer's payment plan, and you typically pay 40 to 50% of the prices across construction. That part is real money and you plan for it. Then the handover arrives and everything changes. The property is now a completed, registered asset. So it can be valued, mortgaged on standard terms, and rented. So instead of settling the bank in cash, you take a mortgage on the finished unit and let the bank fund what is left to complete. And here is the honest boundary, because most people get this wrong. The mortgage covers only what you owe to close. So even if the bank values the unit at a higher or approves you for more, you cannot draw the difference as cash. What you free up is the completion cash that you would actually have paid out of your own pocket. That is the money that walks across the street to the deposit on your next property. And that is how one purchase quietly becomes a portfolio. So let me show you this step by step, because this is where it becomes undeniable. So you buy off plan at 2 million dirhams. On a typical payment plan, you put in about 40 to 50% during construction. So let's say 1 million dirhams of your own cash across the build. Then at handover, you take a mortgage to settle the balance. The bank carries the back half and you own the whole apartment with all of its appreciation. Over 36 months, 11 to 12% annual appreciation on a 2 million dirham unit compounds to roughly 735,000. So a conservative net rental yield near 7% once the unit is handed over and tenanted adds about another 420,000 on top. So the total gain you're looking at is almost 1.15 million dirhams based on current market trends, and this is not a promise, it's just based on the market trajectory. Now let's compare, because this is the whole point. The cash buyer put in about 2 million and made 1.15 million. So that's a 58% return. Quite respectable. The leverage buyer, on the other hand, put in half that, around 1 million, and made the same 1.15 million because they own the same apartment. But it is 116%, nearly double the return on the identical flat, and the only difference is that the bank funded the second half. And before someone reaches for the calculator in the comments, yes, the bank charges interest on its half. And at today's rates, that is roughly 40,000 dirhams a year, and a 7% rent pays it with room to spare. That is what a positive carry means. So even after the bank takes its cut, you're still comfortably north of 100% on your money. The gain itself stays locked in the asset until you sell or refinance. But the completion cash you never had to spend is free the moment you finance instead of paying cash, and that freed capital is the whole game. Now, you could absolutely run this yourself, but most people who try still end up coming to someone like me, because the answer depends on your cash flow, your business, your lifestyle, your life stage, your requirement, and above all, your exit. The math is simple. The fit is not, which is exactly why the asset you choose matters more than the loan you take. So what does this cost everywhere else? Leverage only matters if you keep what is worth keeping. So let me put Dubai next to places a buyer like this actually compares it with. And I will start at home because I grew up there. Mumbai, I love that city, but the math is brutal. And I say that with the utmost affection. Around 6% stamp duty just to buy. Rental yield, if you're lucky, sits between 3 to 4% gross, amongst the lowest of any major city on earth. That rent is then taxed at your income slab up to nearly 30 to 39%. And when you sell, long-term capital gains takes another 12.5. So a flat in South Mumbai can cost more per square foot than prime Dubai, and you pay half the yield. So you're not earning there. You are parking your money in the most expensive traffic jam in the world and paying tax to watch it sit still. London. The non-domicile regime that made Britain a magnet for global money was abolished in April 2025. So worldwide income and gains are now in the net, and estates face 40% inheritance tax. Buy as a non-resident and stamp duty runs to 19% at the top rate once you stack the standard bands, the 5% second property surcharge, and the 2% non-resident surcharge. A serious slice of price is gone before the lift even starts working. So forget the headlines about whether the millionaires are fleeing. Those numbers can still be argued over, but the tax tables can't. New York. A foreign national who is not US domiciled gets an estate tax exemption of just $60,000. Not 60 million, 60,000. Above that, Washington can take up to 40%. So when you sell, a rule called FIRPTA holds 15% of gross price on the way out, with the capital gains and the state taxes on the top. And a property tax bill lands every single year you own it, often a 1 to 2% value forever. So you don't really own it. You rent it from the country indefinitely with a mortgage on top, which technically means you're dealing with two landlords and neither of them is you. Singapore. A foreigner pays additional buyer stamp duty of 60% on any home, whether it's their first or 15th. So on a $1 million apartment, that is $600,000 before a single other fee. And UBS has flagged the market for elevated bubble risk on the top. Now Dubai. You pay 4% land department transfer fee once. No annual property tax, no capital gains on exit, no income tax on the rent, no inheritance tax on the estate. So when you borrow here, the spread you earn stays yours. Everywhere else, you're quietly splitting it with the tax office. And a detail most people miss? Since February 2026, the Property Golden Visa no longer requires that large upfront payment. So a 2 million dirham property earns you a 10-year residency, even with a mortgage sitting on it. And once you are a resident here with your income banked here, your financing ceiling can lift to as much as 80%. So the very act of settling here upgrades the terms on which you buy the next one. This is a city that put property titles on a blockchain before most countries finished digesting their land registry. So Dubai does not announce the future, it quietly files the paperwork. So what decides your terms? Here is what actually sets your rate. It's not your passport, not your bank statement. It's your income credited into a UAE account that makes you a resident client with the best rates and the maximum leverage because the bank can watch it arrive every month. So income banked abroad makes you a non-resident client. Still competitive, just lower leverage and a bigger deposit. So a residency stamp on its own does not move your rate because residency is just the door. Where your income is banked is the key that turns it. One caution, so you don't overpay your deposit, the central bank caps are identical at every licensed UAE bank. So a resident expat borrows up to 80% under 5 million dirhams and 70% above that. The non-resident figure is set case by case. So if any agents who quotes you an exact non-resident number has probably not spoken to the bank yet. Now the honest part, when debt turns dangerous. So leverage is a multiplier, and it multiplies a bad decision with the same enthusiasm as a good one. 3 things you have to respect. First is the rate risk. That comfortable fixed rate converts into a variable one linked to EBOR, which is the Emirates interbank rate after the initial period. The EBOR is benign today, but it sat above 5% as recently as 2024. So do stress test your repayment at that level before you sign, not after. Second is the negative carry. If you leverage a high supply speculative unit whose rent cannot even cover a loan, your debt then turns from an engine to an anchor. That is why I don't finance into the oversupplied corners of this market and why the discipline stays on communities with real demand underneath them. Third is the discipline itself. Leverage belongs on assets with strong fundamentals, not on a flip you're gambling on for a quick buck. Leverage does not fix a weak portfolio, it magnifies whatever you already built. So get the asset right, and the debt is the most powerful tool you can own. Get it wrong, and it is the fastest way to find out that you were wrong. So here is where it lands. The wealthy don't borrow because they are short of money. They borrow because money trapped in 4 walls cannot do anything else for you. The gap between cheap debt and the right asset is the closest thing to free money this market offers, and the smart buyers take it over and over, while everyone in London, New York, Mumbai and Singapore are still working out the tax before they even step through the door. I think about this every time I go back home, because we were raised to believe that owning outright, no loan, nothing owed, is the safe and grown-up thing to do. And it feels powerful as well, right up to the moment you notice that your money has been asleep for the last 20 years. Dubai rewards the opposite instinct. It rewards the person who keeps their capital awake and moving. None of the great fortunes in the world were paid for in cash. Not the old merchant houses in Bombay, not the towers of Canary Wharf. They were built by people who understood one quiet thing. Debt is not the risk, misusing it. So the only question left is an honest one. Is your money working as hard as you did to earn it? If you have to stop and think, you already know the answer. So whether you already own here or you are still holding cash somewhere abroad, this was never about whether you can afford to buy. It is about whether you are ready to let your money finally go to work. So book a call with me and let's have that conversation.